In the last month, we've gotten some U.S. economic data that's a real challenge for the Fed. We've seen a dismal jobs report and stickier inflation, which is challenging their dual mandate for both full employment and price stability. Well, we think one way or another, either economically through a weakening U.S. economy or politically through a replacement of Chairman Powell by President Trump, we are going to see lower interest rates in the future, and perhaps sooner rather than later. So in this gold market commentary for August 15th, 2025, we're going to examine in depth what's happened the last few times the Fed has lowered interest rates and how that has boosted gold higher. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national physical precious metals and vintage U.S. gold coin dealership. If we can help you with any of your buying or selling needs in the physical precious metals arena, we'd love to have that opportunity. In this gold market commentary, I want to discuss with you the dismal July jobs report that we got and the latest inflation reports that we've gotten that are showing inflation's picking up a little steam, which is going to challenge the Fed in their dual mandate. We'll take a look at how gold has reacted in the past when the Fed has lowered interest rates, usually boosting gold and at times substantially. We'll go over the latest charts for gold and silver, and we'll also take a look at some physical specials that we have in the marketplace today that are outstanding. So let's get on with our update. This is a bar chart going back to the beginning of 2023 that shows how many jobs have been created on a monthly basis in the U.S. economy. And as you can see, for July, there were only 73,000 new jobs created, according to the Bureau of Labor Statistics. Now, these figures are remarkably lumpy when they first come out, and they are subject to revision both the second and third month after they are initially reported. And for many of the last 12, 18, 24 months, we've seen downward revisions after the fact. But in the past month, we've got downward revisions that were just enormous. Let's take a look at what happened. June and May at 144 and 147. Now you see them, now you don't. The revisions for May and June were a total of 258,000 fewer jobs, which is an enormous downward revision, in addition to the weak month that we had for July at just 73,000 jobs. Now, this would indicate that the U.S. economy is already entering stall speed when it comes to employment. We have to maintain about 100,000 to 125,000 new jobs every month just to hold the unemployment rate steady. And we've seen these huge downward revisions over the last 2 months and a weak initial month for July, which is what caused President Trump to go into a tizzy and caused Secretary of the Treasury, Scott Bessent, to say, hey, if this is the way it really is, then the Fed should already be lowering interest rates. And he has a point. So let's take a look at what is happening with inflation, which is the other side of the Fed's dual mandate for full employment and price stability. Well, prices on the consumer level for the consumer price index for the headline number have held steady over the past month, but the core inflation is perking up a bit. It's up 0.3 of a percentage point over the last 2 months. So that's headline consumer price inflation, less food and energy. So core prices are rising a bit, which is not a welcome sign. But it gets a little bit stickier when you get to the producer price index, which we have seen prices start to rise pretty sharply over the last couple of months. And this is due to the cost increase impulse that tariffs are now starting to cause. Remember, we haven't really seen tariffs deployed to their fullest degree until just now, the beginning of August. It's August 15th as I tape this. The reciprocal tariffs that were announced in April were put off until the beginning of August in earnest. So we've had slightly higher tariffs, but not the full effect of them, which we're going to get in the third quarter and into the fourth quarter of this year. So this is just the start of what could be higher costs. I heard an analyst on the Bloomberg radio today say that so far, the tariff cost increases are being borne about a third, and a third by first, the vendors that are supplying these goods to the US. They're eating about a third of the tariff increase that is being pushed upon them. Importers in the US are eating about a second third of that cost increase. So their margins are starting to be squeezed by importers. And finally, a third of the tariff cost increases starting to be passed through to the US consumer, which is why we're seeing higher producer price index prices, which are a more immediate sign of inflation, up or down, than the consumer price index, because this is what manufacturers get for their goods when they sell them either wholesale or retail. So we're seeing cost inputs starting to be passed through in earnest to the US consumer. And that is causing inflation to perk up a bit, which brings me to discussing what's going on with the Fed right now and tariffs. The Fed virtually has no control over the cost increases that tariffs are going to create. So by raising the rates and being restrictive, trying to slow down an economy, doesn't make any sense to me, because the higher prices are going to slow the economy down a bit anyway. And if you're an importer, we've already seen probably the economy slow down a bit to start with, because you haven't known for months what you're going to pay for goods. You don't know what the real rate's going to be, because tariffs are on, tariffs are off, tariffs are back on, they're lower, they're higher. We don't know what they are. So a lot of businesses have slowed down importing, which is going to slow down the business cycle, which means if you're doing 10% less because of the uncertainty over the tariffs, well, that means you're probably going to earn 10% less this year, which means the economy is already slowing down a bit because of the tariffs on, tariffs off. And now we're going to see higher cost pass-throughs due to the tariffs, which will slow things down a bit more. So for the Fed to be restrictive in this environment makes no sense to me. And if we do see employment really start to tumble, like we have seen with this July jobs report, which was stunning, then the Fed will be forced to cut rates, and sooner rather than later. They have a meeting in the middle of September. They've got a meeting at the very end of October, and then one more this year in December. So it's very likely that the Fed will start to cut rates in September, probably cautiously at first, because that's how they operate. And it's very possible we may get 2 quarter-point rate cuts before November. But I think that the Fed should cut rates even more. I think Treasury Secretary Bessent is correct, and I'll get to that reasoning in just a minute. But it looks increasingly likely that we are going to see lower interest rates in the US, and probably sooner rather than later, due to economic circumstances rather than political circumstances, next May, when President Trump will replace Chairman Powell with a Fed chairman of his choice who will do his bidding. That will happen. So this is a chart of the one-year federal funds rate in black, which is currently between 4.25% and 4.5% at 4.35% on this chart. The 10-year Treasury yield in red, which has been edging lower after knee-jerking in April. We've talked about that before when tariff turmoil hit. But more importantly is the 2-year Treasury yield in purple, which tumbled lower when the dismal July jobs report was announced. And today, the 2-year Treasury yield is about 3.7%, which is a full 50 basis points or a half a point below the federal funds rate today. The 2-year Treasury yield is where the market thinks the Fed is going to be headed. So we will see, according to market expectations, the Fed cut rates, and probably by 2 25-point basis cuts in the near future, the way things are shaping up. And when you compare where the Fed is today to other major central banks, you'll see that we are abnormally higher than most every other major central bank, excluding Russia at 18%, Brazil at 15%. Russia has a host of issues right now. Brazil has a pretty big inflation problem. India's at 5.5%. They have a modest inflation problem. That's why they're higher than the US, which is at 4.5% on this chart. But below that is the Bank of England at 4%, a half a point below the US. Australia and New Zealand coming in at 3.6 and 3.25%, smaller economies. China is at 3% interest rate, a full point and a half below the US, and their economy remains weak. So they may lower rates, but they do it very incrementally. The Bank of Canada, 2.75%, the ECB at 2.15%. And that's really where the rub is. The US is a full 2.35% above the ECB today, which means compared to the ECB, we are very restrictive and they are accommodating. And that's why Treasury Secretary Bessent seems to think we could lower rates quite a bit to help stimulate the economy. Ironically, the Bank of Japan is raising rates, but they're only to half a point, but they are literally at the highest rate that they've been at in years or decades. And the Swiss National Bank is at 0%. Now, remember, Switzerland just got 39% tariffs imposed on them, which were a bit draconian, in our opinion, for watches and chocolate. But gold tariffs, which were threatened for a day or two, were not actually enacted, which is good. But you can see on this chart how far above the ECB in particular the US is. And we tend to be the highest of the major economies, which is why we have room to drop rates and why I think rate cuts are indeed coming. Just depends on the employment market for September, which the Fed will have that report before their September meeting. And I think that'll be the linchpin for whether we get a rate cut from the Fed in September or not. But either way, we will have lower rates, I think, from the Fed by October or their December meeting, one way or another. It's just how much and how fast. This is the heart of our update. This is the federal funds rate going back to 2007, showing the changes in the federal funds rate and where gold was during each of these tops and bottoms. So starting in 2007, when the federal funds rate was at 5.25%, gold was $600 an ounce. And as we went into 2008, before the great financial crisis hit, the Fed cut rates 2 full basis points and gold jumped $240, or at that point in time, about 30% to $840 an ounce. Now, as we went further into 2008, 2009, and into 2010, the great financial crisis erupted and the Fed dropped rates to zero, which percolated gold all the way up to $1,100 an ounce, which was almost a double from where gold was at the start of that rate cutting cycle. Between 2010 and 2011, due to QE and a continuing just disastrous US economy, gold went from $1,100 to $1,900 an ounce. So I've left that off of this chart because it's not material to the federal funds rate. Let's suffice it to say that while the federal funds rate was at zero between 2010 and 2016, gold held pretty steady. And at the bottom in December of 2015, going into January of 2016, when rates were still zero, gold was at $1,075 an ounce. Now, when the Fed went into that cautious rate hiking cycle between 2016 and 2018, when they raised the rate very tentatively a quarter point at a time, they got to 2.5%. And during that same period of time, gold moved up to $1,340 an ounce. So gold can go up when the rates are rising. Then we got into a global economic slowdown in late 2018 into early 2019. The Fed cut rates about a half a point and gold jumped from 1340 to 1550 in a normal economic weakening environment. And then, of course, COVID hit and rates collapsed back down to zero. and $6 trillion of new stimulus was created, and gold jumped $500 from 1550 to 2060. The Fed held rates at zero going into 2022, and then inflation reared its ugly head, and they were forced to react with the strongest rate hiking cycle in a generation. And they raised rates from zero all the way back up to 5.25%. And gold held steady for most of that time. We did see a dip in gold during the middle of that rate hiking cycle due to extreme dollar strength. I have talked about that in the past. But gold started the rate cutting cycle at 2070. And by the time the Fed had cut rates from about 5.25% to 4.35%, gold gained almost $500, $430, or 20%. So when the Fed cut rates in a normal environment, like they did between 2007 and 2008, and again between 2018 and going into 2020, and again just over the past year from September into the fall, we've seen gold gain 20, 25% in each of these moves lower in normal economic environments. So lower rates are good for gold, especially when the real rate of return that you can get on an interest rate falls below the rate of inflation, which is a negative real yield. Gold tends to thrive in those environments, which is why gold spiked so sharply when the great financial crisis hit in earnest, and when the Fed dropped rates going into COVID from 1.5% down to zero. That's when gold really gets turbocharged. But in the short term, in a normal economic slowdown and normal rate cutting environment, gold can gain 10, 20, 30%. And I think we're looking at something similar right ahead of us, which is why I wanted to get this update out to you. I think the circumstances are ripe for what we're looking for. And I think we're on the cusp of that happening. And you have some time to get ahead of the market. So I do think gold is poised to move higher due to lower interest rates. It's just how much and how fast. And that'll also help to weaken the dollar. The difference that you're getting in the US now in an interest rate compared to the ECB is pretty sharp. The dollar's already taken a pretty big tumble this year, but lower rates will weaken the dollar further. And that'll help to boost gold or help gold to hold on to gains that it might make on a federal rate cut. So one way or the other, I think gold's going higher, and it will weaken the dollar further, which will help to buoy gold. It's a reinforcing cycle. And the dollar's already taken the biggest tumble that we've seen in a 7-8 month period since 1973 during 2025. So the dollar will probably continue to weaken, which is going to be good for gold as well. Looking at a 1-year gold chart, you can see how gold's made a 36% 12-month rolling gain, how we got those big Chinese tariff turmoil-induced gains that took gold from 3,000 to almost 3,500, and now we're moving sideways. So gold tends to make big moves and then move sideways, sometimes for a longer period of time, like it did between 2009 and 2010 and 2011, or from 2021 all the way to 2024. But I think we are going to get a boost from lower interest rates in the US, and we'll break over that 34.34 New York closing high and move into the $3,600 to $3,800 range on lower Fed funds rates. And I do think my $4,000 target for gold this year is still a possibility. We are seeing a rising bottom and a flat top. It's modest inside this choppy trend that we've got between about 3,200 and 3,400. But gold is holding the gains that it's made. It's not giving up very much when it weakens. And I think that that trend is going to continue. And then federal lower interest rates will help to pop gold over resistance at 34.34. And I think we're getting close to that point. Well, if gold has upside potential, I think silver has even more upside potential. This is a 1-year silver chart showing a 35% 12-month rolling gain. The trend line is higher, and it's pretty solid, but it's pretty choppy. As I've said, 2 steps forward, 1 step back. And what's important about this chart is the lower blue line is major support. The middle blue line has been upside resistance, excluding a couple of brief forays above that. And the top blue line is where we have had firm upside resistance. And in the last 2 months, we've seen that upside resistance, which has been a top, broken. And now we're trading above that primarily, which means this market is gathering steam. And that steam could get blown off pretty soon. So we may be getting close to silver actually playing catch up with a vengeance that we've been discussing for quite a while. And that slingshot effect may actually take place. And I do think lower interest rates could be the catalyst for a pretty big pop in silver. If silver gets over $40 an ounce, it's going to create a lot of momentum, and it's really starting to knock on the door there. And this chart looks really solid to me. I don't see much downside at all, and I see a lot of upside potential for those who are patient. Again, 2 steps forward, 1 step back. Buy the dips when you get them. That has served you well over the past year, but the dips that we're getting now are more shallow, and we're seeing a rising trend. So I think the silver chart is looking extremely good right now. This is the 1-year gold to silver ratio chart. The ratio remains high at about 87.5 to 1, with gold at 33.35 and silver at $38.15. I do think silver could play catch up with a vengeance in the very short order, bringing that ratio back down into the mid 70s, like we saw it at 73 to 1 the last time it hit a low, which would take silver into the mid 40s, which is, I think, entirely possible in this marketplace. So silver is undervalued relative to gold. I do think gold will make some good gains, but I think silver will make even better gains, especially if the rate cuts that we see are aggressive. And I think we're poised for that. Looking at the 1-year platinum chart, you can see platinum has made a big move higher. It's broken over real resistance at 1,075 and major longer term resistance at 1,275, running hot all the way to 1,480 before going into a profit taking correction, which has taken platinum back down to about 1,300. Major support right now is at 1275. If it breaks 1275, look for lower. If it holds 1275, which it's doing so far, look for higher. And I do think the trend is pointing back up again, but it's going to be a bit choppy. I like platinum in this market at the 1275 to 13.25 level. But again, 1275 is pretty critical right now. But I like palladium even better. It's scarcer than platinum. It's trading at about a $150 discount to platinum. It's made a nice run as well, moving over real resistance at 1,100 up to 1337 on the spike that we've seen into July. Now it's corrected back down, and like platinum, it's holding support at 1,100. So that is the critical level for palladium right now, 1,100. Above that, look for a few further gains. Below that, look for a bigger correction. So we're testing that as we speak, are close to it, but so far, so good. I think palladium is the most undervalued of the 4 traditional precious metals, but you have to be patient and be long-term oriented. We have some great specials in the physical arena right now. The U.S. investor is not in the market. Stocks have been hitting record highs. So far, things have been pretty good regarding tariffs, but we are starting to see some economic disturbances, as we've pointed out in the jobs market in particular. So we've got some great values on physical gold, starting with we've got a small tranche of British gold sovereign kings minted from 1908 to 1935, featuring King Edward and King George. These are one of the most widely traded, easily sellable international gold coins from the vintage area that you're going to find. They're 0.2354 ounces per coin, a little less than a quarter ounce of gold contained in each coin. So they're trading sized, and you don't have to pay any significant premium for them at 4% over melt, which is our price today. These are a great value. Normally they're 8, 10, and 12% over melt, and they're cheaper than equivalent quarter ounce gold eagle minted today that will cost you about 10, 11, 12% over melt to buy because of the mint's minting charges. So this is a great value in a trading sized, internationally recognized European gold coin. In silver, we have backdate British silver Britannias at $1.99 over spot, about as low as it gets for a major sovereign minted 1 ounce silver bullion coin. It's a great deal for silver, 1 ounce sovereign minted coins at $1.99 over spot. In vintage US gold, we have the $20 St. Gaudens, one of the most popular of all the US gold coins, in gem quality, mint state 65 condition, as low as 16% over intrinsic gold value. So for about 12% more than you'll pay for a gold eagle, you can get a vintage coin that has a 10-year average premium of 39% over gold. Today, it's less than half of that premium at 16%. So there's some opportunity there for long-term holders to arbitrage that premium and get a low premium value today and perhaps trade that out for a much higher premium in the future when demand is bigger than it is right now in the marketplace. And speaking of the world's most popular US gold coin today, we have the 1 ounce US gold eagles at $50 off per coin, just $99 per coin over melt, about the lowest price you're going to find in the nation today for the most popular 1 ounce gold bullion coin, the 1 ounce US gold eagle. All of these while supplies last. If you want to find the specials on our website, simply hold your cursor over that hot deals icon in our gold and silver special section is the very first link below that. That's how you find whatever specials we have. And we rotate them in and out as we have them available. And we see them as good deals for our clients because that's our job, to pass on good values to our clients. So that's our update. Thank you so much for your time today. One way or the other, we are going to get lower federal funds rates in the coming months, whether it's in the coming next few months or a year from now. Either way, the writing's on the wall. And by this time next May, we will have substantially lower rates when President Trump replaces Chairman Powell, if we don't already have much lower rates in the meantime. And that's going to be good for gold and potentially very good for silver. So thank you for your time. Enjoy the rest of your summer. Good luck out there.